Well, good afternoon, good morning, wherever you are in this fine country of ours. Graeme Allan here, Regional Wealth Leader for the eastern part of Canada, IDC WIN. Really happy with the session today, both myself and my colleague Alex Chan out west. Really happy to have Dan Price with us. Dan's from Sun Life, and going to be going into some things that typically we'd like to see more of, but quite often we get bogged down in product presentations. So Dan's going to look at more of case study work and using seg funds and annuities in the planning that you do with the clients that you deal with. So really hoping, looking forward to this one. But before I bring Dan on stage, I would like to read his bio. I do like to read the formal bios to make sure that to establish just the quality of presenters we get to bring on board here and who we have access to. So Dan grew up in southern Alberta, graduated from the University of Lethbridge with a Bachelor of Arts in Political Science. After graduating and achieving his CPA CA designations, he spent over 17 years working corporate finance in both Calgary and Kelowna, and he joined the team in Sun Life in November 2022. That's the work stuff, the important stuff. Outside of work, Dan is married. He has two children that keep him really busy. He enjoys the Okanagan lifestyle and plays most sports. He's a past president of the Kelowna Chamber of Commerce and has previously volunteered as a hockey coach and as a treasurer of the Kelowna Figure Skating Club. So he's a busy guy. We're really happy that Dan's got the time in his schedule to spend with us today. And as I said, I'm really looking forward to this presentation. I hope you get a lot out of it. Please write down questions, comments. We can certainly address those as they come up or on a as needs basis after the call individually. I should note that this presentation is under consideration for Quebec for CE credits, and there will be a couple of polls that pop up during the presentation for our advisors that are joining us from Quebec. So with that, it is 1:02, and I'm going to welcome Dan onto the stage here.
Good morning, everybody. Greetings from Kelowna, British Columbia, and thanks for taking time out of your busy day to join us for this presentation. So here we are in the fall, the leaves are falling, hockey's back. So over the next 50 minutes or so, I'm going to give you some of the training that I wish I got. I think most advisors out there all know about seg funds and annuities in general, but from what I can see in my travels, many lack the detailed strategies to be able to properly position them in their clients' tax and estate plans. So this case presentation today is very case study based, and my hope is that the families that you see on the screen look like people you know. Now, I certainly don't expect you to be seg and annuity experts by the end of the presentation, but my hope is you'll be in a better position to have some great conversations about them with your clients and your prospects, and hopefully you're going to win some new business along the way. So like they say, you don't want somebody else eating your lunch. So if everybody's good with that, let's fire this up. All right, here's our agenda for today. So on the seg fund side of the presentation, we're going to start off with a quick review of how the contract structure works. And then from there, I've prepared 2 estate planning case studies for you. So we're going to look at our borrowing a life strategy and our inter vivos proxy strategy. And then we're going to finish up by discussing how a seg fund contract can benefit your clients and help you grow your book of business. Then switching over to annuities, we're going to start off with a quick overview of the product itself, including taxation and guarantee periods. And once again, I prepared 2 case studies to review. So the first one's a pretty simple one. It's called Creating Eligible Pension Income. And the second one's called Avoiding OAS Clawback While Boosting Cash Flow, which tends to be everybody's favorite. So lots of detail to go through, but I promise you those case studies are going to be worth the wait. So now let's face it, we're not getting any younger and neither are our clients. And as we know, our needs change as we age. And eventually, we do have to think about transferring our wealth. So as an advisor, you might be hearing your clients starting to say things like, I want as little to do with probate as possible. Or one of my kids has drug dependency issues and I don't want to give them their inheritance all at once. They may be saying, I still want my money to grow, but I don't want to take a lot of risk to do that. Or maybe they're just saying, I want things quick, simple, and flexible. Well, if you are starting to hear these things, it might be time to talk to your clients about seg funds. So as you'll see, there's a ton of power within that segregated fund contract, but from what I can tell, it's very underutilized in the market today. So on the one hand, that's a little disappointing, but at the same time, it represents a great opportunity to differentiate yourself out there. So in this section, I'm going to show you how to move around the parts of a seg fund contract to create some amazing estate planning results for your clients. So for example, I'm going to show you how to mimic a trust. So let's take a look. So let's start off by looking at how seg fund contracts are structured using a typical non-registered investment account. So let's take it from the top. So as you may know, there are three parties to any seg fund contract. So first off, we need an owner. So this is going to be a person, a trust, or a corporation who's purchasing the contract. They have all the decision-making powers, and they're the ones that are going to pay tax on any income generated from the fund. So I get that question all the time. Who pays tax on a segregated fund contract? Again, it's always the owner. So next up, we need to have an annuitant or annuitants. So this is the person upon whose life the contract is based. In other words, whose life we're insuring. And now here's the most important point that I want you to remember on this slide. So the contract death benefit guarantees and any resets on those guarantees are always based on the age of the annuitant and not the age of the owner. And finally, we can also name beneficiaries on the contract. So these are the people that will receive the death benefit on the death of the last surviving annuitant. So they can either be living in Canada or they can be living abroad, and they can either be set up as revocable or irrevocable. And as we'll see in the case studies today, there's a lot of power with naming an irrevocable beneficiary when it comes to your estate planning. Now, in terms of flexibility, your non-registered investment accounts are by far the most flexible of anyone you're going to work with. So first off, in addition to single ownership, we can also have joint ownership. As well, you can also name a successor owner. So that person will become the new owner of the contract following the death of the original owner. Third, the owner and the annuitant don't have to be the same people. So this is very unique to non-registered contracts, and we're going to see how we can take full advantage of that in the case study today. And finally, we're also able to name a successor annuitant on the contract. So if the first primary annuitant passes away and the second annuitant is still alive, the contract will continue on and no death benefits will be paid out. So that death benefit is only paid out when all the annuitants have passed away. And finally, tax-wise, on your single ownership accounts, if your successor owner and successor annuitant is your spouse or common law partner, you can benefit from a tax-deferred rollover of that contract on your death. But if you choose anybody other than your spouse or common law partner, okay, no tax rollover is available. Your death, you're going to have a deemed disposition of that contract at fair market value, and you might be subject to capital gains taxes at your marginal tax rate. So there you go, abbreviated Seg Fund 101. So next up, I wanted to just take a brief minute and talk about the 4 different series of products we offer through SunGift Solutions, as we're going to be using some of them in the case studies today. And as well, keep in mind with our all-in-one contract, you can hold more than one series in just one contract. So first off, there in the top left, we have our investment series product. So this is going to be a 75/75 contract, and it's our least expensive option. So all kinds of different funds to invest in. And we tend to use this one a lot for older clients that just want to name beneficiaries on non-registered money to avoid probate. So next up in the bottom left, we got our income series product. And I want you to think of this one like a cashable annuity. So just like annuity, you're going to get guaranteed income for life to address longevity risk. But unlike an annuity, you also have potential access to your capital if you need it. So it might be a great option for your clients that don't like the illiquidity associated with an annuity. Third, there in the top right, we have our estate series product, which is very popular with retirees, and I'm going to be using this one in the case study today. So with this one, you get 100% death benefit guarantees on your deposits right up to age 80 of the annuitant, and automatic annual resets of the death benefit guarantee, again, up to age 80 of the annuitant. So nothing you need to do here as an advisor, as the resets just happen automatically each year on the anniversary date of the contract, assuming that the market has gone up along the way. And finally, bottom right, we got our estate heritage product, which is going to be for your clients between ages 81 and 85. This one gives you 100% death benefit guarantees on your deposits in that age range, but you don't get the resets like you get with the state series. But all in all, 4 great seg fund options for your clients when it comes to their estate planning. So now that we know how to structure a seg fund contract, let's jump right into those case studies. So our first one today showcases what we call our borrowing a life strategy, which can work really well for your elderly clients that still want to benefit from death benefit guarantees and resets later in life. So let's meet our client, John. He's an 85-year-old widower. He's got a daughter named Sylvia, who's 65. And he also has a grandson named William, who's 30. So John's quite wealthy and pays tax at a marginal rate of about 53.5%. Sylvia, on the other hand, pays tax at a much lower rate of 20%. So John's got $500,000 sitting in a non-registered GIC at a bank, and the plan is for Sylvia to inherit that when he passes away. So you've talked to John at length in the past about seg fund contracts that can offer those 100% death benefit guarantees and annual resets right up until age 80. But unfortunately now John's 85 and now he's too old to invest in this type of product. Or is he? Is there a way we can structure the seg fund contract in such a way to allow John to invest? Well, let's find out. So here's what we're going to do. First off, we're going to have John cash in that GIC. And with that money, he's going to buy a SunGift Solutions Estate Series seg fund contract. So recall, this is the one with 100% death benefit guarantees and automatic annual resets. So now here's how we're going to go ahead and structure that contract. So John is going to be the owner of the contract. So absolutely no surprises there. It's his capital after all. But take a look at this. We're going to set up Sylvia as the annuitant. So remember, in a non-registered account, the owner and the annuitant don't have to be the same person. We're then going to set up John as a sole beneficiary on the contract, which might seem a bit weird, but I'll explain why in a second. And finally, we're going to take advantage of being able to name a successor owner on our non-registered funds. And we're going to go ahead and slot Sylvia into that role as well. So again, it's important to note that guarantees and resets here are going to be based on the age of the annuitant and not the owner. So in this case, for the duration of the contract, the guarantees and resets are based on the age of Sylvia. And because she's less than 80 years old, this structure works. So we've essentially borrowed her life, to coin a phrase, in order to be able to invest in this type of guaranteed product. So here's how the contract looks graphically. There's John at the top as the owner. There's Sylvia on the left as the annuitant. And there John is again at the bottom as the sole beneficiary. So now, as you can imagine, this is going to play out in one of two ways. So if, as expected, John passes away before Sylvia, Sylvia becomes the new owner of the contract through successor ownership. Contract would continue as our annuitant Sylvia, again, is still alive, and no death benefit would be paid out at that time. Now, if for whatever reason Sylvia passes away before John, the contract would end, and John, as the owner of the contract, would receive the death benefit. So basically, he gets his capital back in the unlikely event that his daughter passes away before he does. So now let's take a peek into the future and see how things play out. So let's assume that that seg fund contract earns $10,000 in interest income for the next 3 years. And the net asset value, the NAV of the fund, increases like we see on the screen through market upticks. But now let's assume that John passes away at age 88. And at that time, the NAV of the contract is $560,000, and its adjusted cost base, the ACB, is $530,000. So our question is, what happens on John's passing? Well, pretty simple change. John's out as the owner. Sylvia moves into the ownership role, and the contract continues on as our annuitant, Sylvia, is still alive. Let's take a look at the details. So first off, Sylvia becomes the owner of the fund when her father passes away. So our wealth transfer takes place. But instead of inheriting cash, Sylvia inherits the contract and its underlying value. Now, unfortunately, tax-deferred rollover isn't available in this case as it only applies for a spouse or common law partner. And as such, John's going to have a taxable capital gain to declare on his tax return, final tax return of $15,000. So for Sylvia, she's going to inherit the fund with a bumped up ACB of $560,000 to account for the taxes payable by her father. And she's got a couple different options at this point. She can either redeem the fund or she can continue to hold it and benefit from annual resets of the death benefit guarantee until she reaches age 80. As well, if she keeps the fund, Sylvia can now name her son William as the new beneficiary. So we set up the first generation wealth transfer from John to Sylvia, and now we're setting up the second from Sylvia to William. So were we able to help out John with our borrowing life strategy paired with our estate series product? Well, first off, we're able to give him privacy in the settlement of his affairs by having the assets transfer outside his estate through successor ownership. So if those assets went through his will, they could be made public, as we know. Second, he wanted Sylvia to inherit the non-registered account funds, and again, we get this through successor ownership. Now, in terms of lifestyle needs, John's wealthy. He doesn't need any money from the contract, but if he did, we could easily set up a systematic withdrawal plan, and we could do the same for Sylvia once she becomes the owner of the contract. The arrangement's simple. It's just one contract. It's flexible, and that John can make changes to it during his lifetime very easily, as long as he still has the mental capacity to be able to do that. We can protect John's capital through customized portfolios. We have those maturity and death benefit guarantees, and we also get those annual resets of the guarantees up until Sylvia turns age 80. And we're also providing tax efficiency through probate fee savings. Okay, this wasn't available to John when he had that GIC sitting at the bank. And finally, there's also an additional benefit here that we don't have shown on the screen. While he's alive, John maintains control over the asset. So for example, as successor owner, Sylvia has no rights to the contract until John passes away, which means that in the event of a divorce, Sylvia's spouse couldn't go after the contract while John's alive. So great result there for sure. So as we saw, our borrowing life strategy produced a lot of benefits for the family. But the question is, could we have done better for John here from a tax perspective? So for example, John's paying all the taxes on the contract at his high rate of 53%, and we also had that capital gain to pay tax on when John eventually passes away. So could we somehow restructure the planning here to achieve some income splitting with Sylvia and take advantage of her lower tax rate, and as well kick that capital gain into the future and benefit from tax deferral? Well, of course there's a way. Why would I be here if it wasn't a way? So let's take a look. So that brings us to strategy number 2, and we call this one our inter vivos proxy strategy, or as I like to call it, gifting with strings attached. And this is a great little strategy for your parents out there that are hesitant to gift during their lifetime, but really want to do some income splitting within the family. So just by way of quick review, an inter vivos trust is simply a living trust. So with this strategy, we're going to show you how to use a seg fund contract to try and get some of the benefits of inter vivos trust without the cost or complexity of setting up a formal trust agreement. Don't get me wrong, trusts are great, but just like any estate lawyer will tell you, not everybody needs one. So let's get into it. So here's what we know so far. We know John's very well off, and he doesn't need that $500,000 to live on. We also know that he pays tax at a very high rate, and we know that Sylvia is eventually going to get the money. So John's actually considering gifting the funds to Sylvia right now, but he's just not 100% sure that that's the right thing to do. He would feel more comfortable gifting now, however, if he could maintain a degree of control over the funds during his lifetime. So let's see if we can help him out here. So this time, we're going to have Sylvia come down to your office, and she's going to set up the seg fund contract. And she can do that for just a minimal amount. So in this case, Sylvia will be the owner of the contract. So remember, previously, it was John. Sylvia is going to remain as the sole annuitant, so no changes there. But this time, we're going to change up the beneficiaries big time. So first off, we're going to name Sylvia's child William as a 99% revocable beneficiary. And John's going to be set up as a 1% irrevocable beneficiary. So imagine the wheels are spinning here just a bit, right? This seems a little weird, doesn't it? Why is John involved here? Why is he only a 1% beneficiary when William's at 99%? And why is he set up as irrevocable when William's set up as revocable? Well, stay tuned for the answers. Now, once that contract is set up and signed off, John is then going to fund it with his generous gift of $500,000 as a third-party contributor, which is just as simple as filling out the proper form and getting the funds over to Sun Life. And finally, just like our borrowing a life strategy, for the duration of the contract, guarantees and resets are based on the age of Sylvia. So here's how our structure looks graphically. So the changes that we made from borrowing a life are shown there in green. So there's John at the top right as a third-party contributor. Sylvia is on the top as the owner. And there's our two beneficiaries at the bottom, William for 99% and John for 1%. So really, the only thing that hasn't changed here is that Sylvia is still the annuitant. So Sylvia is the owner of the contract. Any income from that fund is going to be taxable to her and not to John. So Sylvia has a much lower tax rate than her father. This is going to result in tax savings for the family, about 33% in tax savings, in fact. As Sylvia is the annuitant, the contract continues after John's death. So no changes there whatsoever from our previous borrowing a life strategy. But this time, as Sylvia is the owner of the contract, there's no capital gains taxes payable on John's death. So this is going to result in tax deferral, as this tax doesn't have to be paid until Sylvia eventually passes away at some point in the future. And as well, it should also be noted that given that Sylvia is over the age of 18, there's going to be no income attribution back to John on this contract. Okay, important point to remember. We definitely don't do this strategy a lot for minors, as you can imagine. Now, here's the key to the strategy, though. As John set up as an irrevocable beneficiary, even for just the token amount of 1%, he's able to maintain a degree of control over this contract while he's alive. So, for example, Sylvia is going to need his consent to make major changes to that contract, which can include such things as changing out John's irrevocable beneficiary designation. If she wants to add a successor owner or successor annuitant after the contract's established, John's got to approve that. She needs approval if she wants to surrender or donate the contract. But now here's the big one. She's going to need John's permission to make withdrawals or change a pre-established income schedule on that contract. So I liken this again to gifting with strings attached. So for example, I have a son, maybe I'm feeling generous one day, and I decide to give him $100,000 to be used as a down payment on a home. But once I put that money in his bank account, legally, what's preventing him from taking that money out and buying a sports car, let's say? Whereas if we go with the seg fund structure here, I'm named as an irrevocable beneficiary. When he's down at the car dealership, he phones Sun Life, tries to get the money out of the contract. Sun Life will give me a call as the irrevocable beneficiary, and they're going to ask me whether I approve that transaction or not. To which I will say absolutely not. We're laying down the hammer here, and the money in that contract remains. So now let's take a look at the tax difference between John owning the contract and Sylvia owning the contract. So recall that each year that contract's going to allocate out $10,000 in interest income. So under our borrowing a life strategy, where John was the owner, this is going to produce taxes each year in the amount of just over $5,300. Whereas under our inter repos proxy strategy, where Sylvia is the owner, taxes payable are just a shade over $2,000. But take a look at the difference in that far right column, $3,348 per year, or over $10,000 over that 3-year period. So now we're getting somewhere. As well, we mentioned that capital gains tax when John passes away. So this is going to be $8,030 under our borrowing life strategy. But under inter vivos proxy, where Sylvia is the owner, there'd be no capital gain tax until Sylvia eventually passes away. And finally, under either strategy, we're saving about $8,400 in probate costs, which again, couldn't happen when John had that GIC at the bank. So pretty good results either way, but even better from a tax perspective when using that inter vivos proxy strategy. So again, were we able to help out John with our strategy? Well, essentially, we have most all the same benefits as we did under borrowing a life, but this time we're also getting tax savings by having income taxed in Sylvia's hands instead of John's, tax deferral by avoiding that capital gain on John's passing. All the while, John maintains some control by being named an irrevocable beneficiary. So really good results for our clients here. So as advisors, I'm sure you're seeing a lot of gifting during lifetime these days. So grandparents to grandkids, parents to kids, et cetera, et cetera. So if your clients are hesitant to gift now, this might be a really good strategy for them. So again, it's a bit like gifting with strings attached. And as you can imagine, we model this one a lot here at Sun Life. So overall then, as we saw in these two case studies, you can create different results for the same family by simply moving around the parts of the contract and taking advantage of such things as successor ownership and irrevocable beneficiary designations. So that's the true power of seg funds and wealth transfer planning. It's in the contract. So now to wrap up our seg fund section of the presentation, let's quickly summarize where a seg fund can be valuable for your clients. So here's a quick summary of some of the potential uses and benefits of seg funds in your clients' wealth transfer plans. So first up, we have capital protection and preservation. So we saw that our various seg fund series have guarantees that help you protect your capital. So investment series and income series come with 75% death benefit guarantees, while estate series and estate heritage come with 100%. So by having those 100% guarantees, your clients could, in theory, go a little heavier into equities than they normally would later in life, knowing that they have some protection in place. So a decent little way to try and grow an estate for someone that would normally be in a GIC. Estate planning is a huge benefit of seg funds. So we saw in the case studies that wealth transfers can take place seamlessly through either successor ownership or by naming kids or grandkids as beneficiaries. And for those parents out there with concerns about giving their child a lump sum inheritance all at once, we can use a term or a life annuity to pay out that death benefit from the contract. So third, we can get potential guaranteed income for life if we use that income series product. So again, this one's a lot like an annuity, just with access to your capital if you need it. Control and flexibility is a big thing for clients. So as we saw a few times in the case studies, a properly structured contract allows the owner to maintain control of the assets during their lifetime. As well, we also saw you can also maintain some control when gifting during your lifetime. And best of all, changes can easily be made without cost if your circumstances change. So maintaining privacy is also a big one. So maybe you want to give more money to your favorite child, or maybe you have a child that nobody knows about. Well, either way, you probably want to keep things private. Probate fee planning is another huge reason to use segs. So seg funds allow you to name beneficiaries on non-registered funds, and thus allow you to bypass the estate and probate. So let's face it, no one wants their assets to all go through probate if they don't have to. Low contract minimum. So this is an interesting one that I really didn't get into in the case studies today. So we're telling advisors and their clients that it's never too early to start your estate planning. So for just a minimal amount, you can set up a seg fund contract and get your beneficiaries in place for your non-registered money while you're still in great health, and then you can always fund the contract later on. So that way, everything's in place just in case you lose capacity. You don't know if you're going to get hit by a bus tomorrow or succumb to early onset dementia. Who knows? So POA in many provinces can fund the contract on your behalf later on, but unfortunately a POA can't name or change your beneficiaries. So again, for just a minimal amount, you can get your estate planning done at a younger age. And finally, there's also potential creditor protection available. This is going to be on your client name accounts with the proper beneficiaries in place. So there you have it, all kinds of different reasons to use a seg fund in wealth transfer planning. The competition knows about these, and now so do you. So we just saw that seg funds can be a powerful tool for your clients. But now let's switch gears and talk about another powerful tool, that being payout annuities. So if I were to ask you, how can you use an annuity to help your clients? What's the first thing that comes to mind? Well, I'd be willing to bet that most of you said to provide guaranteed income to reduce longevity risk. And if you did say that, you're most certainly correct. Annuities are a great tool for addressing longevity risk. Now, I'd also be willing to bet, though, that very few of you said that it can play a big role in retirement income and tax planning. So, for example, did you know that once you turn age 65, the interest income from non-registered annuities is eligible for both pension income splitting and the pension income credit? And if you didn't know that, I can tell you with certainty that you're not alone. So let's get deeper into annuities by starting off with a quick overview of the product. So let's face it, annuities are pretty simple products overall. The client pays a one-time premium, and in exchange for that, they're going to receive a series of guaranteed payments for either a specific period of time or even for life. It's important to note, though, that a payout annuity contract can't be partially or fully surrendered at any time, and thus has no cash surrender value. But as a result of this, along with the power of insurance credits, we can provide higher guaranteed income for life than we can with other products. So just as a quick review, there are 4 key roles in any annuity contracts. So first off, we have a policy owner. So they must be a Canadian resident for tax purposes, which means they live and file taxes in Canada. As well, the policy owner is responsible for taxes and can choose or change the beneficiary on the contract. We also need an annuitant or annuitants. So just like the policyholder, they also have to be Canadian residents for tax purposes. Annuitants must be alive for income payments to be made. When they die, the income stops unless there's a guarantee period remaining. And if the last surviving annuitant dies during a guarantee period, a death benefit from the contract gets paid out. And finally, it's also important to note that if registered money is being used to purchase the annuity, the annuitant and the owner do in fact have to be the same person. So third, we have the payee, or the recipient of the income. And the main point that I want to make here is that the policy owner, annuitant, and payee are often the same person, but not always. So for example, the payee might be a Sun Life insurance policy, for example. And finally, we can also have a beneficiary who can receive the death benefit if the guarantee period is chosen and the annuitants die during the guarantee period. Now, in terms of issue ages, we can issue an annuity between ages 18 and 100 for registered accounts. However, they are subject to legislative restrictions. So for example, here in BC where I live, the ages are going to be between 19 and 100. And for non-registered accounts, that range is going to be between 0 and 100. Right? So basically no restrictions there. In terms of premiums, it's a $5,000 minimum, which I think shocks people when they see that. It's very low. Premiums over $5 million do require medical underwriting, but that's only going to be for life annuities, not term annuities. And finally, for annuities that are $2 million and less, we can price them internally. But for anything over $2 million, we do have to send it off to our custom pricing team for a custom quote. As you can see on the screen, all kinds of different sources of premiums for an annuity. You can do them from your RSP accounts, your RIF, your LIRAs. You can do them from RLSPs, DPSPs, your various LIF accounts. Registered pension plans are a very popular spot to do annuities with. And finally, you can also do them in your non-registered accounts as well. In terms of payment frequency, all kinds of different options available. We can pay monthly, quarterly, semi-annually, or annually. Now, in terms of payment options, we also have a number of different options to choose from. So first off, you can do level payments. So just like that name implies, the payments amounts are going to remain the same throughout the selected period. We can also do an index payment. So when this option is selected, your income is going to increase each year by a fixed percentage. It's going to be between 1% and 4%, chosen at the time of purchase, and this helps your clients guard against inflation. Third, we can do what's called a reduce in payment on a joint life annuity. And when you select this option, your income is going to reduce by a certain percentage when the first annuitant passes away. And finally, we can also do what's called an integrated payment. So here again, annuity income is set to decrease when your CPP or OAS benefits kick in sometime down the road. So Sun Life also offers the ability to defer income on the annuity into the future. So generally speaking, deferring results in higher income payments down the road. So as you can see on the screen, many accounts allow for deferral up to 10 years from the purchase date, but keep in mind there are restrictions as to when income payments have to begin. So for example, as you can see above, for a non-locked-in RSP, you can defer income from 10 years for the purchase date, but income from that annuity must start by the annuitant's 72nd year. So I'm not going to spend any more time on this chart, but please note that it is available online as part of our Sun Life Annuity Guide if you want to check it out further. So now, what exactly are some of the key benefits of annuities for your clients? Well, first and foremost, we offer income for life. This is going to be on single or joint life policies, and this takes away your client's fear about outliving their money. Annuities also provide protection, and that's going to be from market and interest rate fluctuations, as well as for inflation if we go with that indexed annuity. No active management is required. You simply buy it, put it away, and collect your money. You get a surest protection, which is nice, as we saw all kinds of options to customize income. And finally, there's also potential creditor protection available if the proper beneficiary designations are in place. All right, so that wraps up our quick overview of the annuity product. Let's switch gears now and get into my favorite topic, taxation. So as you likely know, each payment that you're going to get from an annuity is going to consist of two parts. There's going to be a return of principal, and there's also going to be an interest component. So for an annuity purchase for registered funds, that entire income payment, so both principal and interest, is going to be taxable to you in the year it's received. Now, conversely, for an annuity purchase with non-registered funds, only the interest portion is taxable, and there's going to be two different tax treatments available. One's called prescribed taxation, and the other is called non-prescribed, which is also known as accrual taxation. So now let's take a deeper dive into these two different types of tax treatments. So let's start off with accrual taxation. So with this tax treatment, the amount of taxable income you report each year is going to change. So in general, there's going to be higher taxable income in the earlier years of the policy, and then taxable income is going to decrease each year after that as you start to get your capital back. So as you can see in the chart at the bottom, in year one, taxable portion of that income payment, the orange area, is just under $4,000. But by year 10, on the far right, you can see it's next to nothing. So now let's take a look at prescribed taxation. So this time, the interest portion and return of capital stays exactly the same each and every year. So therefore, a fixed portion of each payment is going to be taxable to you. So as you can see in the chart below, the taxable portion, so again, the orange area, stays exactly the same over the 10-year period of this annuity. So now let's take a look at a quick case study on accrual versus prescribed taxation on a life annuity. So first off, ton of information on the screen. Don't worry, I'll bring in some animations to help you focus your attention. But in the meantime, here's our assumptions. We got a single life annuity for a 70-year-old male, $100,000 premium. We're going to give him a 10-year guarantee period. And when we punch this into our software, this is going to produce monthly income payments of $632 for life. Now, there's a couple things that really stick out on this chart. So first off, as expected, under accrual taxation, taxable amounts are higher at the start of the contract and decrease each year after that. Whereas the taxable portion under prescribed taxation stays exactly the same at $1,492 each and every year. But the really interesting thing, though, is that with prescribed taxation, the total taxable income you report will be much less than under accrual taxation. So for example, by age 88, the total income to date under accrual taxation, $27,606, whereas it's only $13,429 under prescribed taxation. So So that's quite the difference, less than half, and it only gets larger as more time passes. So overall then, you can see that prescribed taxation can be a real benefit for the right client. So next up, we're going to discuss what happens when the annuitant dies during the guarantee period. So in general, we're going to pay a death benefit from an annuity contract in one of two scenarios. So the first is if all annuitants die before the income start date, and the second is if income started and the annuitants die during the selected guarantee period. So as I mentioned, you're able to choose the length of the guarantee period at the time of annuity purchase. Maximum is typically 40 years, does vary by source of premium, and it's important to note that it can't be changed once the policy is issued. So a couple of quick points here before we move on. First off, in terms of a sweet spot, we see a lot of 13 to 14-year guarantees, as this is typically when your clients have all their capital back. And secondly, believe it or not, an annuity with a 10-year guarantee can be cheaper than one with no guarantee. So be sure to price that annuity both ways. So now let's finish up this section by looking at a quick little case study on guarantee periods. So here's the case facts. We got our client Angelo. He purchased a life annuity with his non-registered money. Chose a 15-year guarantee period and made his son the beneficiary. He chooses April 4th of 2014 as the income start date. And it's important to note that the income start date is also when the guarantee period kicks in. So first, let's assume Angelo dies on July 5th of 2024. As this is within the 15-year guarantee period, a death benefit from the contract would be payable. And now let's assume that Angelo dies on September 8th of 2030. As this is now outside the 15-year guarantee period, unfortunately, no death benefit would be payable. All right, we did it. We made it through the technical portion of this section. So now it's time for the fun part, the case studies. So the two you're about to see are actual cases we've worked on over the last few months. First case study is a pretty simple one, and it's called creating eligible pension income. Now, before we get into the case study, let's quickly review what qualifies as eligible pension income for tax purposes. So CRA has got a great summary of this available online, so I encourage you to check that out as well. So first off, in general, if you're under the age of 65, there's very little that qualifies as eligible pension income without restrictions. The main one to be aware of is that income from an employer pension plan qualifies at any age. So as you can see in the box, no restrictions on this income qualifying. Now, once you hit that magic age of 65, there's all kinds of other income that qualifies without restriction. So for our purposes, we see that the interest portion of annuities now qualifies. And we're going to see how we can take advantage of that in the case study here. So here's the case facts. We got spouse A and spouse B, married couple. Spouse A is 65. She pays tax at a marginal rate of 40%. And she's got $1 million sitting in a non-registered account from the sale of a rental property. But at this time, she's got no eligible pension income. Spouse B is a year older. He's 66, pays tax at a lower rate of 25%, but he also has no eligible pension income at this time. Now, stepping back from this, we can see that spouse A is going to be taxed at a high rate on any income earned in that non-registered investment account. So the question is, can we save the family a few dollars in taxes each year by using an annuity? Let's take a look. So here's the plan. We're going to have spouse A use $500,000 of that $1 million in the non-reg account to buy a life annuity. So based on our assumptions, annual income from that annuity is going to be just over $33,000 per year, of which just under $14,000 is going to be taxable to spouse A. Now, given that she's age 65, spouse A can elect to split up to 50% of this taxable income with spouse B. So if we go ahead and do that, both spouse A and spouse B are now going to declare just under $7,000 of taxable income from that annuity on their tax returns each year. So what are the benefits of this strategy? Why on earth would we do this? Well, let's start off with spouse A. So first off, she's going to gain access to the pension income credit. And this is going to result in $300 of real federal tax savings, plus any additional savings through provincial pension tax credits. Next, she created eligible pension income with non-registered money that's now eligible for income splitting. So this means that almost $7,000 of that annuity income can be taxed at spouse B's lower rate of 25% instead of spouse A's higher rate of 40%. So this represents a 15% tax savings opportunity that's going to save the family $1,047 each year. So good results for spouse A. Let's take a look at spouse B. So just like spouse A, he also gains access to the pension income credit and the same tax savings that we see above. So we managed to multiply access to the pension income credit with this strategy. So great results for this couple from a tax perspective, and the client gets protection through guaranteed income for life. So personally, anytime I'm working on a case where the clients are between ages 65 and 71, one of the first things that I do is pull their tax returns and see if they're getting income splitting and the pension income credit. If not, annuity is a great option to save your clients some money. Also keep in mind, you only need to generate $2,000 in annuity income per person, so $4,000 per couple, in order to maximize the pension credit. So in reality then, you really don't need a large annuity to be able to do that. But that being said, a larger annuity might be appropriate if you want to do more income splitting. So overall, a really simple yet very effective solution for the right client, yet I see it get missed time and time again, especially when you're only drawing on non-registered assets and not yet starting your RIF. So our final case study of the day is called Avoiding OAS Clawback While Boosting Cash Flow. So just like the name implies, this one's for your clients that are paying back OAS because they simply make too much in retirement. And the solution might be as simple as swapping out a GIC for an annuity. So let's take a look at this GIC buster. So let's meet our client, Heather. She's 70 years old, lives out in Ontario. She's a widow, very conservative investor. She's got $1 million sitting in GICs, some cashable, some not. She's currently living in a retirement home, but she's in great health and now she wants to travel more. So this is big for her, which is why we got it in bold there. But just like many of our clients, she's also concerned about outliving her money. She also tells us, I don't want to lose any of my OAS. That's free money. What can I do? So anybody else on the call today have a Heather or two in their client base? I'll bet you do. I know lots of people that don't even want to lose a dime of OAS under any circumstances. So the good news is, though, that we can use an annuity here to help Heather out. Let's see how. So I'm not going to bore you with the mechanics of the OAS clawback. I'm sure everybody's very aware that you're going to lose 15 cents of OAS for every dollar that you earn above the OAS threshold. So this amount when we created this presentation was $86,912 back in 2023. And now that amount's sitting just over $94,000 here in 2025. So this clawback basically represents an additional tax of 15%. So avoiding it is a really good plan here. So as you can see on the left, Heather has a number of different sources of retirement income. She's got her CPP for $15,600. There's that OAS coming in at $8,400. Currently getting $50,000 in interest income from those various GICs. And she's got a RIF of $22,000 per year. So in total then, without planning, her net income is going to come in around $96,000, which unfortunately is going to result in an OAS clawback of $1,363. So not a huge amount, but again, we have a client here that doesn't want to lose even a dime. Now, a bigger problem, though, is that she now doesn't have enough after-tax cash flow to meet her living expenses now that she wants to bump up that travel budget. So let's see how an annuity can help her out here. So first off, we're going to have Heather cash in 50% of those GICs. So let's just assume she can do that. With that $500,000, she's going to purchase a lifetime annuity. We're going to go with a single life annuity, get prescribed taxation. We'll give her a 15-year guarantee period, and we're going to ask for monthly income. So based on those assumptions, that annuity is going to pay her $32,500 per year, of which only $14,200 is going to be taxable to her. So now let's see how this small change in investment strategy impacts Heather. So here are the major changes to note. So first off, investment income from those GICs is going to drop from $50,000 down to $25,000 per year. We're then going to bring in that taxable portion of the life annuity for $14,200, and we now see that our net income drops to $85,200 per year. So there's no OAS clawback as our income is now below the threshold. So great news there. And finally, we're going to layer in the non-taxable portion of that annuity payment for $18,300. And lo and behold, her net cash flow now comes in at just over $86,000, which is now well above the $82,000 that she needs to live on. So I know this is a very popular slide when I deliver this presentation live or over Zoom. So I'm going to stop for just a few seconds and give you a chance to digest what you see on the screen, which is basically presenter code for I need a drink of water. So overall then, from a tax perspective, we reduced Heather's net income by $10,800. And in doing so, we eliminated that dreaded OAS clawback, thus saving her $1,363. Secondly, we increased her net cash flow by just over $12,000 to meet Heather's needs to travel more. And finally, we've given her guaranteed income for life, which addresses her concern about outliving her money. So all in all then, the annuity allowed us to boost our cash flow without boosting our net income. In fact, we managed to reduce her net income. It's a pretty good result for the client here. So for you advisors out there that are interested in this OAS strategy, I highly recommend identifying your clients that are in that $95,000 to say $125,000 net income range that have a portion of that income coming in from something like a GIC. And not only does this strategy work for OAS, but you can also use it to try and keep your clients in those lower tax brackets. So as we know, in many provinces, the tax rates in those lower two brackets, pretty attractive, but they start to jump pretty quickly once you hit brackets 3 and 4. So maybe you can use an annuity to drop your clients back into those attractive second bracket. Definitely food for thought. So as you saw in the two case studies then, the benefit of an annuity can go well beyond simply addressing longevity risk. And truth be told, we just scratched the surface on strategies today. So for example, we can also use annuities when your clients exit company pension plans and to defer income taxes on RSPs and RIFs that are left to minor beneficiaries or to family members that have disabilities. As well, you're seeing a lot of your peers across Canada moving their small dollar RIF and LIF accounts into annuities, which might be a win for both you and your clients. Your clients get protection from market volatility, and hopefully you get some of your time back by not having to service these small dollar depleting accounts. So again, food for thought. And with that, that brings us to the end of our presentation today. So hopefully I've given you some new ideas on how to use seg funds and annuities to provide some creative solutions for your clients. And if you like this presentation, we do have separate presentations on both segs and annuities that include some of the case studies that you saw today, along with some additional ones. So be sure to reach out to our team if you want to see those. Now, we did go fairly fast today, so if you feel like a concept went over your head a bit, don't worry. I'm more than happy to do a one-on-one session with you afterwards and go over the strategy again slowly. Don't feel bad for asking. I do it all the time. And finally, they say that the hardest step in a marathon is that first step. And once you get started using these products in your business, my guess is you won't stop. So keep in mind, people like myself here at Sun Life are here to help you grow your business. I work on seg fund annuity cases a lot, tend to work backwards on these. So you tell us the results your client wants, and we'll help you design a contract structure that checks the boxes. And with that, I want to thank you for your time today. And I'm going to turn things back to our host for any final comments.
Perfect. Thank you, Dan. That was awesome. Lots to think about. Hopefully it planted lots of seeds for people to ponder over and think about clients that can use the various things with. There's a number of questions come through, so we'll go up. I'll get as many in before we close things up at 2 o'clock. First question, in regards to the first strategies talked about in seg funds, can this be used instead of TFSA?
Yeah, you can do seg funds within a TFSA. You know, truth be told, a lot of the estate planning benefits are already built into a TFSA because you can name beneficiaries. But you know, that being said, we do use that guaranteed income for life concept within a TFSA a lot as well. You know, tax-free guaranteed income for life, very attractive to people. So yeah, you know, different accounts we can apply a lot of the different strategies to. So we'll give you the pros and cons of, you know, going with either type of account for sure.
And I should mention that these are obviously things that can be taken up with the individual wholesalers as well from Sun Life as after the fact and regular conversations. Second question: does this strategy work with registered accounts? Again, that's specific to the seg fund side.
The strategies for registered accounts?
Yeah. Does it work with registered accounts? I mean, I know what you presented on was a non-registered.
Oh, yeah. I got you. Yeah. Some of the strategies you do have to be careful, right? Like a RIF account, for example, if you work with nominee accounts, unfortunately, you can't name irrevocable beneficiaries, right? So that type of strategy wouldn't work. That said, if you have client name accounts, you're okay there, or you can try to replicate the strategy sometimes with a non-registered investment account and get similar results as well. So again, just have to be careful. Devil's in the details, as they say. So we'll definitely give again, if it's feasible or not, we'll tell you either way.
Yeah, perfect. So here's one here. If Sylvia is joint account with John in his GIC, will the seg fund still be beneficial if Sylvia has right to survivorship? I
So if we
guess
went
that's
with
on
a
the
joint
GIC account.
account, this is if we went with a joint account instead.
Yeah, yeah.
Yeah, you know what? I like joint accounts. I'm not gonna bash joint accounts. I like them with spouses. Don't like them as much with kids. You know, you do see some problems associated with them, such as, like unclear intentions and exposure to creditors of the kid, or even loss of control for the parents. So if you do a seg fund solution, perhaps set up the daughter in that case with a POA, you can get pretty similar results with the joint account. Just you avoid some of the problems associated with it.
Right. Here we go. Would an interviewer's trust be expensive to set up and maintain?
It can be, it depends on where you live and how complex you want it. I've talked to estate lawyers and they'll be the first to admit that, again, not everybody needs a trust. So I've heard some estate lawyers say if your estate is going to be $1.5 million or less, it might not be economically feasible. So they'll actually recommend their clients to look at other solutions as well. So case by case basis, if you're willing to spend the money, it might get up there, it might not. So it really just depends what you want to do. Complexity definitely factors into the cost for sure.
Next question. We're getting real close in time. Will
Yeah.
annuity income affect GIS eligibility? I guess the guaranteed income supplement.
Yeah, sure will. It's taxable
Okay.
income. Yep.
Okay. Let's see here.
That being said, though, I should add though, like it's with that return of capital though, the
Mhm.
hit's not going to be as bad as if you got that same, payment from a GSE, let's say, because GSE it's all interest, all taxable. So
Right. I'm going fast here just to get through the last ones. On
it's
income
like
splitting.
rapid fire in here, right?
I know this is awesome. I love it. On income splitting, is the maximum to 50% only, or is that
Yeah.
it can be changed?
Yeah, you can go less if you need.
Okay. And finally, I've had a couple of requests. Is it possible to get a copy of the presentation, or is that something IDC can get hold of to put on our website?
Yeah, unfortunately, we don't give out copies of the presentation,
Okay.
but we've been working really hard to try and come up with, short little 1 page, 2 page little marketing quick hits for you
Yep.
as well that can illustrate some of the strategies you talked about today. For example, Borrowing a Life, I've got one of those, just with involved families that are easy reads that you can probably sit
Okay.
down with your client and go through as well.
Perfect. And this is the last one here. What happens if the client dies 5 years after setting up the annuity strategy to save the OES? Would she lose a lot more from losing the rest of the annuity?
Yeah, we anticipated that in the case study. So we went with that 15-year guarantee. So the death benefit's going to be paid out to her
Okay.
heir. So it's not like the money evaporates, but very important again that you sit down and think about, okay, how much do I want to guarantee this, right? I can go as little as 0 or I can go as high as 40 years. Again, the sweet spot's probably around the 15-year mark. So we'll definitely, walk you through that as you're setting
Perfect.
it up as well too. We don't like people setting up just 0. So
Wonderful. Well, listen, it's 2:01. Thanks again from all of us here at IDC. It's a pleasure to have you on board and have the partnership with Sun Life. And I hope that there's lots of calls, not just to me, but to the wholesaling team to go into this in more detail. We all win if that happens. So thank you very much. Have a great afternoon.
thanks everyone.